today we're talking about which retirement accounts to draw first. Last week's episode was on the retirement tax break that pays you an annual income. Go back and check that out if you missed it. So let's jump on in. When it comes to retirement, we often focus on saving and financial preparation. But what about actually accessing your hard-earned money that you saved all this time? Well, in this video, we'll guide you through the important steps for withdrawing your retirement funds strategically, maximizing your income, and minimizing taxes. Just as you consult a doctor for your health, it's crucial to understand the withdrawal order for your retirement accounts. So let's begin. First place, cash, okay? Your first source of income in retirement should be cash, assuming you already have an emergency fund equal to 6 months of expenses, minimum. Okay, 6 to 9, right? For example, so if your monthly expenses are $10,000 and you have $100,000 in the bank, well, withdraw $40,000 from your cash reserves first. Drawing from the cash keeps your taxes low in the early years of retirement. It also provides an opportunity to move money from a traditional IRA or any pre-tax account into a Roth at a potentially lower tax rate. Okay, second place, taxable accounts. Once you've withdrawn down to your emergency fund, it's time to tap into your taxable investments. Withdrawals from these accounts, such as individual, joint, and revocable trust accounts, are often taxed at much more favorable long-term capital gains rates if held for longer than a year. Okay? And the third place, Social Security. However, it's important to note that tapping into Social Security isn't automatic once you exhaust your taxable accounts. There are break-even points based on life expectancy as well as tax and legacy considerations. So, having a Social Security analysis done will be beneficial to help you to determine when the best time to start withdrawing them. Social Security benefits can be withdrawn as early as 62 and as long as up to age 70. Waiting longer typically results in higher income. Okay, and then the last place is pre-tax retirement accounts. And this includes traditional IRAs, 401ks, 403bs, and other tax-deferred accounts. Since these accounts will be taxed as income upon withdrawal, it's often beneficial to wait as long as possible, especially if before full retirement age for Social Security, and if you're working part-time or have some side hustles. However, the IRS eventually will require you to take required minimum distributions, RMDs. And you want to also note that the Secure 2.0 Act eliminated RMDs for all Roth accounts, by the way. And so this means that you can potentially never withdraw from these accounts and pass on tax-free wealth to your heirs. Okay? This article doesn't mention tax-favored buckets like Roth or cash value life insurance, but these accounts can be used as buffers to your accounts that are in the market. So what that means is those years where you have volatility and withdrawing from these accounts definitely comes in handy to give your risk accounts a chance to recover from that volatility. And so I like to call these my double Dutch accounts. Jump in these whenever and when it makes financial sense to do so. Okay. There's a great book out by David McKnight that really explains this concept called the volatility shield, how to vanquish the 4% rule and max your retirement income. Comment book below and I'll send you guys a copy, an e-copy at no cost. Okay. And so just remember that these withdrawal guidelines serve as a general framework because every retiree situation is different. right? And it's important to consult with a fiduciary financial advisor to tailor a strategy that suits your needs, because this order is really relative based on your bucket, your current assets, your income sources. There are so many variables. And so getting a custom income plan and understanding the proper withdrawal order for your retirement accounts can really ensure you a steady income, tax efficiency, and a fulfilling retirement. So to read more about this update, click on the link below. And I really hope that you found this information helpful and exciting, and it prompted you to get motivated and take action to improve your financial future. See you guys next week for another episode where we'll share and discuss the impact of interest-only loans coming due on pre-retirees, on money motives. Good news from the world of finances. Remember, stay motivated to find your dream destination. See you guys next week. Take care.